Subscribe to our YouTube channel and press the bell icon to get the latest updates.
Dear viewers, in today's IPO, I am going to share 3 critical parameters that you must assess any IPO on that you wish to invest in. Now, after a spectacular rally over last 2 years, 2022 has been a rough year for investors, and this is especially true for unseasoned first-time investors. The Russia-Ukraine war, high inflation, supply chain issues, FIIs exiting the market, and Fed hiking interest rates dampened the sentiment this year. While the correction caught the investors off guard, it was high-flying new age IPOs that fell the most. In less than a year of listing, some of these much-hailed IPOs have crashed up to 60% or more. Now, you would think that this experience would make investors cautious. But that has not been the case. With just slight recovery in the market sentiments, IPOs are back in vogue. Cinema SGS technology has already hit the markets. Even in a choppy market, the issue was oversubscribed and climbed 42% in its debut trade. Another IPO issue, DreamFox, has been subscribed 56 times. While PharmEasy has withdrawn its offer amid some resistance to its ESOP plan, over Rs 500 billion worth of IPOs are likely to hit the market this year. These include the likes of Oyo and MobiKwik that are either loss-making or turned profitable for the first time just ahead of the IPO. So, will you remember the fate of Zomato, Paytm, Policybazaar, and Delivery as these upcoming IPOs vie for your attention? Most of these names took a sharp hit as pre-IPO investors, that is, promoters, employees, and institutional shareholders, rushed to exit post the expiry of the lock-in period. They did not find value in these stocks even at beaten down levels. Despite their fate, I am not surprised that IPO fever is back again. After all, there is an army working to hype them up as future multibaggers. And as the cycles of greed and fear suggest, good stories are hard to resist. But before you get carried away, there are 3 things that you must look for. First, does the IPO you are considering investing in has enough promoter skin in the game? Did you know that the founder's stake in stocks like Zomato, Paytm, Policybazaar, Cartrade Tech, and Delivery is less than 10%? None of these IPOs are under promoter category. Hence, there is no compulsion to disclose buying and selling of shares in the open market. The link between businesses that have zero profits and with nil or little skin in the game of promoters is not at all surprising. Another commonality is reckless acquisitions. Now compare this with the likes of India's 3 most profitable unicorns, that is startups valued over $1 billion, Zoho, Zerodha, and Musicma. They are entirely owned by promoters and promoter groups and have no VC or PE investors. Because the skin in the game is significant, one is prudent with the use of money and wants great returns for every penny invested. Here is Mr. Nitin Kamat's view on why he did not take VC money who were willing to offer blank checks. While it is tempting to take the money, you will then have to build the business in a very different way. We have never had any of the revenue or growth targets which we are obligated to chase once you take external capital. And this is what Nassim Nicholas Taleb has to say on the matter. Entrepreneurs are heroes in our society. They fail for the rest of us. But owing to funding and current venture capital mechanisms, many people get mistaken for entrepreneurs and fail to have true skin in the game in the sense that their aim is to either cash out by selling the company they helped create to someone else or go public by issuing shares in the stock market. The true value of the company, what it makes, and its long term survival are of small relevance to them. This is a pure financing scheme, and we will exclude this class of people from the entrepreneur risk taker class. This form of entrepreneurship is equivalent of bringing great looking and marketable children into the world with the sole aim of selling them at age 4. We can easily identify them by their ability to write a convincing business plan. Second test. Does the IPO you fancy have significant ESOPs issued at unreasonably cheap price and without any linkage to profitability and business performance? Well, this could lead to further future dilution on the equity base. Especially for loss-making businesses with no visibility of profits, the cost of these ESOPs is ultimately borne by minority shareholders, that is you, without getting any reward of past growth. Third test. Don't get carried away by the list of big VC and PE investors in an IPO. After all, most of these investors use IPO event to dump their shares on retail investors. Look at their entry levels instead. It is likely to be much lower than the offer price at the time of the IPO, even if the funding round happened just a few months before the IPO. A lot of these early investors or even late investors before IPO make a profitable exit through the offer for sale at the time of IPO. It is often the retail investors who end up holding the bag. As the IPO season seems to be back, I hope you will keep these points in mind before betting on the next big IPO. With this, I've come to the end of this video. Do let me know through your likes and comments if you find this information interesting. Subscribe to Equitymaster YouTube channel for more such updates. Thank you for watching. Goodbye.